Welcome back to The Explainer. Today, we're decoding something that is going to completely transform how you look at a trading chart. We are talking about the hidden battles happening right in front of us, literally hiding in plain sight. We're going to dive deep into mastering candle wick psychology.
Look, we've all been there. Tell me if this sounds familiar. You buy a breakout and it instantly fails. You see the price absolutely surging. You jump in because, well, you don't want to miss the move, and then bam, the market violently reverses and completely wrecks your stop loss. It is beyond frustrating, right? But what if I told you that those painful losses actually leave a very distinct visual footprint? Understanding the psychology behind those wicks is your ultimate solution to stop getting trapped. So to fix this, let's start right at the foundation.
Section 1. The Anatomy of a Wick, the Foundation of Psychology.
So what exactly is a wick, geographically speaking, on our charts? Well, a candle wick, or a shadow, as it's often called, is simply the area where the price traveled during a specific time frame but was rejected before the candle actually closed. Basically, it shows us exactly where the market attempted to go but completely failed to sustain itself. It's a footprint of a failed move.
There's this really cool core dynamic at play on every single candle you look at. The body, that represents the market's final decision, the accepted price. But the wick is pure, raw market emotion. It's the rejected price. Wicks are literally the battle scars left behind from the conflict between buyers and sellers.
Moving to Section 2, the Psychology of Rejection. Who is actually in control here?
The crucial thing to understand is who is fighting this battle. On one side of the ring, we have everyday retail traders. They're out there panic buying or selling breakouts, totally driven by FOMO, the fear of missing out. But on the other side, we have the institutions, the smart money, and they are not panicking at all. They are calmly absorbing all that retail pressure and actively hunting for liquidity. When retail buys the breakout, smart money is usually the one happily selling it to them.
Let's break down exactly what these wicks mean. An upper wick, that signals a bearish rejection or a supply zone. The psychology there is that buyers got totally trapped trying to push the price up, and institutions heavily sold into them. Now, a lower wick is the exact opposite, a bullish rejection or a demand zone. Sellers got trapped and smart money bought up the discount. And if you happen to see wicks on both sides of a candle, that's just pure indecision and volatility. Nobody has clear control. Honestly, the best thing you can do there is just sit on your hands and wait.
All right, Section 3. Smart Money Liquidity Traps. This is all about liquidity and manipulation. You see, institutions deliberately use these wicks to set traps. Why? Because they need massive amounts of liquidity to fill their massive orders, and they know exactly where that liquidity lives. Retail stop losses almost always sit right above obvious swing highs and right below obvious swing lows. To smart money, those stop losses aren't protection. They're just a giant pool of resting orders waiting to be triggered.
Let's walk through how a buy-side liquidity grab actually plays out. Step 1. Price breaks a previous high. Suddenly, the chart looks incredibly bullish. Step 2. Retail breakout traders rush in to buy, and the short sellers from earlier, their stop losses get hit, which forces them to buy too. It creates this massive flood of buy orders. And then, Step 3. The trap snaps shut. Institutions sell their huge positions right into that flood of retail buying. The price reverses, closes lower, and leaves behind a massive upper wick. Those buyers? Completely trapped.
And you know, it works exactly the same way in reverse for a sell-side liquidity grab. Step 1, price breaks a key support level. Step 2, retail traders panic and sell the breakdown. Existing longs get stopped out, again, forcing them to sell. Step 3, institutions calmly step in, buy up all those deeply discounted sell orders, and reverse the price straight back up. The result is a long lower wick that leaves retail bears completely stuck.
Now, keep this in mind. Size matters here. The size of the wick is a direct gauge of the manipulation. A big wick means a really strong rejection. It's a massive liquidity sweep with heavy institutional involvement. A small wick, though, that just indicates a smoother directional move without that intense battle. Basically, the larger the wick, the stronger the psychological trap.
Which brings us to Section 4. The rule of location. This is where wicks work best. I want you to really let this quote sink in for a second. Location gives wick its power. Seriously, a massive wick right in the middle of nowhere on your chart, it means absolutely nothing. It is just random market noise. But that exact same wick at a critical key level, now that is an absolute game changer.
So where exactly should you be hunting for these? Your most effective wick locations are going to be key support and resistance zones, previous day highs or lows, trend lines, and gap zones. Ignore the wicks floating in random mid-chart areas or stuck right in the middle of sideways consolidation. Oh, and a crucial tip from the source material. Higher time frames offer way more reliable signals. A wick on a 15-minute chart carries significantly more psychological weight than a wick on some noisy, choppy 1-minute chart.
Finally, Section 5, Trading the Setup Safely. Let's get into execution and the rules. All right, here is your step-by-step battle plan for a bullish setup. Step 1, you spot a long lower wick precisely at a support zone. You see the liquidity grab happening. But step 2, and this is where most retail traders completely mess up, you must wait. Wait for a confirmation candle to actually close above the high of your wick candle. A wick all by itself is not an entry trigger. Once you get that confirmation, step 3 is entering the trade and placing a strict stop loss safely below the absolute low of that wick.
And for shorting the market safely, we literally just flip the script. Step 1, spot that long upper wick at a key resistance level. A beautiful bull trap. Step 2, exercise patience. Wait for the confirmation candle to close below the low of that wick candle. Step 3, enter the trade and tuck your protective stop loss just above the absolute high of the wick. If you do this, you are officially trading with the smart money.
Now, before you run off to your charts, I want to rapid fire some of the most common mistakes traders make so you don't become someone else's liquidity. First, do not trade every wick blindly. Do not ignore the overall market structure just because you see a shiny pin bar. Never ever enter without that confirmation candle we just talked about. Don't ignore where the true liquidity zones actually are. And finally, never confuse a simple rejection with a guaranteed reversal. Sometimes a wick is just a brief pause before the trend keeps going. You have to respect the structure.
So we've seen how the shadow of a candle is really just the visible story of rejection, liquidity, and manipulation. Smart money absolutely uses these wicks to create fear and trap emotional traders. But once you know how to read it, the wick shows you the trap perfectly. So my final question to you is this. Now that you can actually see the hidden narrative on the chart, will you be the hunter or the hunted? Thanks for hanging out with me on this explainer, and hey, happy charting.